Hey guys, Roddy Walker here today, and today we're going to talk about prime versus subprime loans. Right. Okay, great. So let's get started. So some of you guys may have heard of the term prime or subprime. I'm going to bring up one of my favorite blogs that I got off the MyFICO website. And if you want to learn more about credit, I think it's best for you to explore the MyFICO website. My biggest goal is to help you guys improve your lives financially, mentally, physically, however you want to put it. Please like and subscribe if you enjoy this content today. First things first, we're going to go into an article, and this was an article that was written by Clint Proctor. A little bit about Clint is basically a founder of a website called WalletWiseGuys.com, publicized in Business Insider, US News, Yahoo Finance, and finally Forbes. He does have some great credibility. Going into this article, I'm looking forward to kind of breaking down to you guys what his stance is on prime and subprime loans. So FICO scores are one of the key metrics that lenders use to evaluate borrowers' credit worthiness. For this reason, your credit score can impact not only the lender's approval odds, but the rates and terms that you're offered. Borrowers with stronger FICO scores may be offered prime loans, while borrowers with bad or damaged credit may only qualify for subprime loan options. But what exactly do these terms mean? Let's take a closer dive in. That way you guys have a better understanding of, I guess, the different tiers of prime and subprime loans. First things first, prime versus subprime credit score ranges and can vary by lender. This is a great example that Clint kind of put to kind of help describe these different ranges. I'm going to start off with super prime. Now, super prime is what you'll see. I guess it's like the best possible lending you can get if you're getting super prime. That falls into FICO scores being 720 or above. That's when you're going to get super prime offers from different lenders. Now, prime, that's where I fit in. That's where probably most majority of people probably fit in, which is going to be FICO scores of 660 to 719. And that's kind of like good or average or what. So I've been in super prime before, but I've been using my credit a lot. So I have been taking dings. That's the main reason why I'm not in super prime currently, but I will get back there. Near prime, that's going to be 620, 659. Again, there's probably a lot of people in this bracket. You know, it's kind of like a C reporting. Now, near prime, you're not going to get all these crazy things, but you will get accepted for certain things. Like near prime, people in near prime can still basically get mortgages and stuff of that nature. Subprime, that's when you get down. So now we're going from near prime to subprime. Now that's when your credit score is anywhere from 580 to 619. There's different products offered to people in this range. You've noticed secured credit cards, different loaning programs where the rates and the terms are not as favorable, but yet they have solutions for people in this score range as well. And the reason why they're not as appealing as the prime or the super prime rate is because there's more risk when lending money to these people. Maybe they have things in collection. Maybe they have late payments. You know, there's certain risks on their report that put them more in the subprime category. So when you apply for subprime products, then they tend to be less favorable. But, you know, at least there's an option. At least there's something that these people are offered rather than nothing. And last but not least is the deep subprime. And that's basically anything 580 or below. And these are going to be the worst terms and rates you can imagine. And it makes sense why, because it's the worst scores. It's the people who, you know, probably have bankruptcies, probably have a lot of different things that have gone wrong on their credit. No one's to say that you can't fix it. A lot of people have that attitude that when I'm at 580 or below, or when I'm at a low credit score, that it's over for me. And I just want to say that that's not the case. There's plenty of ways to fixing your credit. Just like anything else in the world, there's things you can do to change that. Same thing with your credit. If you want to make your credit look good, if you want to start qualifying for things, if you want life to be a little bit different, then yeah, you're going to have to follow a plan, just like a workout plan, to get your credit back on track. And if you want to learn more about that, feel free to shoot me a message or a DM. I have Instagram. I also have YouTube, and then I have my email as well. That's linked to my Instagram. So feel free to reach out to me for some credit consulting. Long story short, guys, those are some of the major differences. I'll read a couple more paragraphs in the article so you guys get a little bit better understanding. Let's go over personal loans, so that way you guys get a gist of how this works in the personal loans realm. If you need fast cash, it can be tempting to visit payday loan companies or other lenders that offer short-term personal loans without credit checks. But some of these loans may not be in your best interest. And many of these loans may come with fees or other interest rates so high the borrower can easily get trapped into a debt cycle. So some of these subprime products that you're entering can lead to you being in a worse financial situation than you are already in. So if you're begging for money, you're low, trying to get back, like this is actually digging you deeper in the hole. So you got to be careful when you see products like this. You may be able to avoid these types of loans by taking out a payday alternative loan from a local credit union. Generally, these loans don't come with charges more than $20 fees and have a minimum interest rate of 28%, which isn't great, but you know, hey. PLAs come in loan amounts of $200 to $1,000 terms, 1 to 6 months. This sounds like it would be a safer route than maybe those payday loans, quick cash loans, something you can look up with your local credit union to see if that's something you can qualify for to help you. Let's go into auto loans and kind of see how this works in the world of auto loans. Some car dealerships offer in-house financing that may be geared towards borrowers with subprime credit scores. In fact, some of these buy here, pay here dealerships proudly advertise their no credit, no problem policy. But these loans can come with high interest rates. And in some of the worst case scenarios, you may pay more than the vehicle is actually worth by choosing those buy here, pay here dealership financing. But you may have better options before you start the car buying process. See if you can get pre-approved for a loan with a lender or bank or credit union. In some cases, you may be able to secure a much better deal with a third-party lender than the dealership's in-house financing option. So when you go to a dealership, you'll notice that they're working to try to get you financing. But little do you know, they're running your credit through tons and tons of lenders, when you could individually go to each bank and credit union and try to find the best rates yourself if you look further than the dealership. I would probably never use dealership financing. It doesn't feel genuine to me when I go to a dealership. It feels like they're trying to get me in something that works best in their benefit. So I want to go elsewhere when looking for the financing. I may get the car from them, but I'm getting the financing outside of their establishment. Let's go back into this. Credit unions can especially be effective to discover new car loans and rates. As you can see, credit unions are typically a lot more favorable in that matter. They're a lot more fair, a lot more easier in some cases with credit just in general. According to the National Credit Union Administration, the average 48-month loan for a used car in Q3 of 2020 was 2.08% points lower at credit unions than banks. So targeting credit unions is the way to go. And credit unions were better at 48-month new car loan rates too by an average of 1.80% points. So points is like the percentage, the fee for getting the finance. So 1.8, you times that by the amount of the total purchase price, and that's the fee for financing. If you notice, hey, I bought the car for $8,000, but it says $10,000, that's the extra financing fee, that percentage of points that you're paying. Mortgages in the early 2000s, subprime mortgages were fairly easy to come by. So subprime mortgages, as we come back to that word, the mortgages for the lower credit rates, right? So high risk mortgage loans. Many mortgage lenders only accepted borrowers with low FICO scores, but also failed to verify that that borrower had enough income to make those loan payments. And now we go back to the results and the practices of the mortgage crisis back in 2008. The reason why this happened, basically the mortgage, if you look at it nowadays, you can only get a mortgage loan with prime lending. There's not a lot of everyday lenders that are going to give people low things. And the reason for this is to protect people for what happened in 2008, when majority of people could not afford to make the payments on their home. Mortgage companies are now more regulated and must follow higher underwriting standards. However, subprime mortgages are still available. Like I said, they're still available. Often these loans come with adjustable rates, and it means it easily can rise dramatically over time. So I would never recommend getting into a subprime mortgage loan unless you know what the hell you're doing, and maybe you're an investor in real estate and you plan to make money on top of these higher interest rates and adjustable rates that can change, make your payments higher and low, and just nothing's like fixed. Subprime borrowers who are looking to buy a house that will be their primary residence may also be able to take out a fixed FHA loan. Borrowers may qualify for a FHA loan with FICO scores as low as 580, and the down payment could be as low as 3.5%. And if you're able to put down 10%, the FHA FICO score minimum can be as low as 500. So there you go. Like, this is a solution for people, who obviously fit that more subprime category. All subprime products aren't the greatest, but I have to say that FHA is a pretty damn good one. And I myself have an FHA loan, so it's been really great for me, and it's helped me do real estate and invest. So yeah, I can't speak anything negative about it, except for the fact that maybe not the long-term strategy you want to go with. VA and USDA loans are two government-issued home loans that lineate credit requirements, but it's important to note that while subprime borrowers may get approved for a loan through the help of these programs, they'll still be unlikely to qualify for the best available rates at that time. So just know that when you do apply for these at the 580 or 500 range versus me, like I got the FHA, but I got it with like a 680 credit score. My rates were probably the best rates you could get in that range because I wasn't a subprime borrower. But just be aware of that. Now, the question that all of us want to ask is, are subprime loans worth it? I'm going to kind of go off what Clint says in his summary, and then I'll kind of finish it off of my take on it as well. There are times when it's simply not practical to wait till you qualify for prime loans. For example, you may need to buy a car immediately so that you can continue to make it to work each day. For situations like these, taking out a subprime loan can make sense. But even if it's necessary to take out a subprime loan, you'll still want to shop around with multiple lenders to compare rates and terms. In other situations, you may be better off to take out a loan until your FICO score has improved. This could especially be true for large loans like mortgages, where even a slight interest rate difference can significantly impact how much you pay over the life of the loan. Remember, the information in your credit reports is constantly updated, and your FICO scores are too. By following solid credit habits over time, a subprime borrower can become a prime borrower. All I have to really piggyback off those statements, because it was pretty right on the nail, is like, if there's certain things that can benefit your life right away and you're in the position to make that change, obviously like get a car or whatever, then it makes sense to do subprime. But maybe some things where you're in prime status, it makes sense. Like if you want to save on the life of a loan just based on the interest rate, because that's 30 years. So if you have an interest rate of 6% versus 3%, that's a big difference in money if you're talking $600,000 for a home. So I'm just saying, in certain scenarios the subprime loans are necessary, and then in certain scenarios the prime loans are better to wait for and get. Well, that will do it for the rest of this video. I hope you guys learned a lot. Please like, subscribe, leave a comment letting me know what you thought, some feedback on the information you got today. I hope you guys enjoyed this video, and I hope you have a great rest of your day.